Hello, everyone, and welcome to Trading Asia Live. What to expect from markets when the Trump tariffs kick in. I'm your host, Masayuki Yuda, Nikkei Asia's market editor in Tokyo. And we have two panelists joining us today, Lisa and Jada. Would you like to introduce yourself?
Yeah, hi, I'm Lisa. I cover Asia financial markets together with Jada. My coverage spans stocks, FX and rates, and asset management, and I'm interested in stories that follow the money across Asia.
Hi everyone, I'm Jada Nagumo. I cover markets together with Lisa. I've been with Nikkei since 2015, where I've covered Japanese stocks mainly, but also corporate finance, and corporate governance is also a topic I'm passionate about.
Thank you, Lisa and Jada. Today's main topic will be U.S. President Donald Trump's Liberation Day tariffs and how they shook global financial markets. From day one, the global markets went quite turbulent, and Asian markets initially followed suit. But soon went slightly decoupled and became a go-to destination for investors bridging risks brought on by the president's flip-flops. The trend continued as the U.S. dollar and Treasuries stumbled. With uncertainties darkly clouding the future, the 90-day tariff pause was set to expire on July 9, which is tomorrow. But it looks like we have now virtually a pause until August 1st. In this webinar, Lisa, Jada, and I will discuss now how experts are calibrating the tariffs' impact on real economy, and how investors plan to trade during the renewed tariff war. But before starting the webinar, I would like to quickly introduce our market feature series, Trading Asia, which obviously our webinar title is based upon. This Monday feature of ours looks into the latest shifts and trends in Asia's asset trading markets, namely equities, bonds, forex, commodities, and even properties. Through Trading Asia stories, we intend to provide you with new market views and trading ideas to begin your week. So I would appreciate if you could visit our homepage every Monday morning, and check out the market feature. Okay, enough sounding too advertising. Let us now jump right into the webinar. We would like to shape this webinar around three following big questions. One, how has Trump rocked the market so far? Two, how have investors reacted so far? Three, what market impact should we expect as the pause expires? Hopefully answering those questions would give you some basic information, understanding, and ideas on what had happened, what is currently going on, and what might happen in the near future. But before going into those three big questions, we've been seeing new tariff developments recently. Breaking news came in overnight, making this webinar even more timely for us. Could you give us the latest updates on the tariff situation, Lisa?
Sure. The big thing that happened overnight is Trump levied new tariffs of 25% for Japan, South Korea, Malaysia, and he announced new tariff rates for a bunch of other Asian countries. But for Japan, the 25% rate is 1 percentage point higher, and for South Korea, it stayed the same, unchanged. And these new tariffs are going to, or are expected to take effect on August 1st. But in his letters, Trump wrote that these tariffs, and I quote him, may be modified depending on trading partners' relationship with the U.S. So he left a bit of room for potentially more negotiations. According to Capital Economics, excluding auto tariffs and sectors that have been tax exempt, around 55% of Japan's shipments to the U.S. will now be subject to the new tariffs, and that figure stands at around 45% for South Korean shipments. And we were up early this morning covering what experts were thinking about this new levies that we got overnight. And Wendy Cutler of the Asia Society Policy Institute, who was the former deputy U.S. trade negotiator, said that these new tariffs on Japan and South Korea suggest that the U.S. will likely not offer any reprieve for sectorial tariffs, including auto tariffs. And if true, this could be concerning for Japan and South Korea because lowering auto tariffs has been a top priority for both countries. What I thought was interesting is South Korea and Japan were the first ones to receive Trump's letter. And when asked about it, White House press secretary said that it was the president's prerogative and that those countries were just the ones that he chose. So we didn't really get much explanation as to why these two countries were chosen as the first ones. Trump made clear his growing frustrations with Japan recently, and last week I think he made a lot of comments indicating that he's frustrated with trade negotiations. And I think based on what I read from the Asia Society Policy Institute, part of Trump's frustration, according to the Institute, is tied with Trump's unfounded belief that Japan would somehow be an easy negotiating partner. But as you know, as we've reported many times, the timing is tricky for Japan because we have an upper house election that's set to take place in less than 2 weeks. But still, the result is quite disappointing for Japan because Japanese trade officials openly and proactively reached out to Washington right after April 2nd, Liberation Day, and reciprocal tariffs initially kicked in. So it's sort of a setback, but negotiations are still available based on what Trump wrote in the letter. I think more importantly, the new tariffs is not good news for corporate Japan because a lot of the countries had assumed the 10% base rate in their forward guidance for this year, and some of them didn't even factor in tariffs. So going forward, we might start to see companies revise their earnings outlook. Regarding South Korea, the timing, again, is unfortunate because South Korea just had an election around a month ago, so they have a new government, and they likely needed more time to prepare for such big trade talks. And now we're seeing Europeans rush to negotiate a deal with the U.S., and they're hoping to lower their tariff rate to the 10% base rate, which is what initially Japan, at least Japanese investors had hoped. So we're going to keep a close eye on whether Europe would be able to get that deal. And Jada will touch more on how Asian markets reacted.
Thanks, Lisa. So actually, Lisa and I and Yuda-san were up pretty early this morning writing a market story following Trump's announcement. So please go check that out after the webinar. But overnight in Wall Street, the Dow Jones fell around 1%, while this morning stocks in Tokyo and South Korea it held up pretty well. Both benchmarks are slightly up. And for Japan, the 25% tariff level is, as Lisa mentioned, 1 percentage point above the April 24% announcement. But Trump had recently threatened to impose 30 to 35% tariffs on Japan. So investors may have digested the 25% as sort of not as bad as I was thinking. So when compared to about 5 days ago, the Nikkei stock average, Japan's benchmark, is largely flat, mainly because there is uncertainty surrounding the outlook for corporate earnings, with investors still weighing the details from Trump's latest announcement. But there seems to also be a level of taco trade going on, where investor sentiment has been supported by the belief that Trump always chickens out at the end. We did see Vietnamese stocks climb to its highest level in I think over 3 years following its trade deal with the U.S. On the currency front, the Japanese yen, South Korean won depreciated against the dollar this morning. The yen has also weakened against the euro to around a 1-year low. Gold futures in the Japan trading hours early this morning were up also thanks to the safe haven flows. We aren't seeing really what we did on April 2nd and in the following days, where there was a rapid risk-off spread of risk-off. And this is likely due to things still being very uncertain, and many investors are taking a sort of a wait-and-see approach. there seems to be a level of optimism that the new August 1st deadline will give countries and governments more time to negotiate and could lead to more trade deals. But this isn't to say, though, that we won't see any volatility in the coming weeks because trade tensions are indeed brewing, I think.
Thank you both. The situation sounds still quite uncertain, while we have a few more weeks to negotiate until the pause virtually expires by the end of this month. Now, let us begin tackling the three big questions we raised. So the first question is, how has Trump rocked the market so far? This goes back all the way to the last fall, around the time of the presidential election. Last year, we had a big stock market crash in the summer, but the sentiment quickly recovered with investors betting on tech stocks, especially those related to AIs. We are wondering what might happen after the election. Could you tell us, Lisa, on how markets have traveled after Trump's election victory to the days before the Liberation Day?
Sure. Let's go back to November of last year. Could you put up the first slide, please? So November last year, Trump got elected, and Asian currencies immediately tumbled, even including the Japanese yen. And back then, Trump policies were seen strengthening the dollar, whereas currencies of South Korea, Malaysia, Indonesia, and Taiwan were seen as being really vulnerable because of their trade linkages with China. A lot has changed, and we'll gradually get to it. And as for stocks, it was a mixed picture. Hong Kong, China stocks, mainland Chinese stocks were lower because investors were worried about another round of trade war happening, whereas Japanese stocks were higher because the yen was weaker. And then come February, we saw this massive rally in Hong Kong listed Chinese tech stocks. And I think this went on to show that AI theme was playing out separate from geopolitical tensions. But then in March, Trump slapped those 25% tariffs on automobiles and automobile parts. And this was really alarming for South Korean and Japanese automakers because they make up a significant portion of their exports to the U.S. And these two countries are really export-dependent economies. Share prices of Japanese and South Korean automakers fell when Trump slapped those tariffs.
If you're interested in knowing the impact on the auto industry, could you quickly pull up the slide 2, please? A Trading Asia written by Lisa and Jada in mid-May did a fine job portraying the market impact on this auto sector, and so I would appreciate if you could give it a read. Separately, during the first half of this year, I remember waking up many times to President Trump's posts floating tariffs ideas and undermining the U.S. Federal Reserve's independence. And if you could put up the slide 3, please, here. These are some of the market-moving posts that he made. So excluding the U.S. after hours, Tokyo often became the first international market to react to those posts and was often rocked the most. And then came the actual Liberation Day. What did we see on the day and the following weeks, Lisa?
Yeah, so Liberation Day was super busy for us. Asian stocks plunged almost across the board. Vietnam and Japan stocks led losses because both countries were hit by tariffs higher than expected. And this is around the time when we really began to see safe haven assets like the Japanese yen and the gold surge. Case in point, Japanese yen appreciated to the 140 level in the following days, all the way from 150 levels. So we saw a surge or investors really run for safe haven assets. But Asian stocks also continue to fall as Trump doubled down on keeping tariffs in place. But things changed when U.S. government bonds sold off, the dollar depreciated, and U.S. stocks also sold off. And this combination of the three I think really went on to indicate very high global investor anxiety about U.S. markets. While Trump said that he wasn't keeping an eye on U.S. stock market, it seems as though he was keeping an eye on bond markets because he pumped the brakes on U.S. tariffs after U.S. Treasury yields surge. And even at one point, we even reported about it. The biggest mystery in global financial markets was who sold or who was selling U.S. Treasuries. Some people were saying that it was a Chinese selling U.S. Treasuries. Some people are selling that it's the Japanese. And these two countries are the two largest foreign holders of U.S. debt. So there was a lot of market rumors. And I think it really went on to show that investors were concerned that a top haven asset, the U.S. Treasuries, their yields were going up, meaning prices were going down. And this really reflected mounting, if not heightened, investor concerns. And then in May, we saw Taiwan dollar record a historic two-day rally after a magazine article say that U.S. might demand Taiwan strengthen its currency. So exporters are believed to have sold their U.S. dollar, while Taiwanese insurers are believed to have increased their hedge ratios. And this was a stark reminder of Asian businesses starting to gradually shift away from the dollar. And earlier last month, Israel-Iran war threw a curveball, which Jada will get to. And what I think right now, from where we stand, what I think is interesting is investors are really, really not happy with uncertainty, and uncertainty is still high. But stocks in U.S. and some in Asia have done really well. For instance, South Korea's benchmark Kospi is up 28%. Hang Seng is up also more than 20%. Nikkei is almost nearing the 40,000 level. So we are seeing this continue rise in stocks, which I find interesting.
So I've been a market writer since I joined Nikkei in 2006, and I've covered several market turbulences, including the global financial crisis in 2008 and the European sovereign debt crisis in 2010. Investor sentiment recovers fairly quickly from stock market crashes, but then when the bond and credit markets get battered and bruised, it often makes investors quite worried. And that is partly due to the size of the market. The bond market is said to be about twice as big as in amount as the stock market, so the financial damage could be huge. The other market that went volatile because of President Trump's policies was the commodity market. Jada, could you elaborate on what we've seen in the commodity market, especially regarding the oil and the tensions in the Middle East?
Yes. So as Lisa briefly mentioned, in addition to Trump's tariffs, markets witnessed tensions in the Middle East escalate just last month. Concerns over Israel and Iran possibly going to war led to soaring oil prices, which were pushed up further after the U.S. conducted strikes on Iran's nuclear facilities. And also due to Tehran hinting that it will possibly close the Strait of Hormuz. Slide 5, please. As a result, Brent crude oil surged to a 5-month high of over $80 per barrel. And however, there were wild price swings after Trump announced a pretty abrupt ceasefire, and prices of Brent as well as the WTI plunged. This also affected energy and defense stocks in the markets like Tokyo and Seoul, where we saw shares in such companies surge one day but then fall the following day due to the ceasefire. We also briefly saw prices of alternative fuels, namely palm-based biodiesel, like Malaysian palm oil, being affected during the height of the conflict.
Okay, thank you, Jade and Lisa. So that was the quick overview of how President Trump has rocked the market. The next big question is, how have investors reacted so far? In other words, how have investors repositioned their investments to sell through this rough waters? You two have been in the forefront of our market coverage through this turbulent period. We've talked a little bit about the receding of the U.S. exceptionalism earlier. Lisa, could you elaborate on what led investors to partially step away from the dollar assets?
Yeah, so although US is still the most liquid and deep market in the world, we've started to see investors hedge their dollar assets. If not, they've started reconsidering their US exposure and whether or not they should increase their hedge ratios. Unstable policy and Trump's threat to the Fed's independence have shaken investor confidence. US Treasuries are, again, considered the safest of pretty much the safest assets in the world, but we saw investors express their eroding confidence in April. But Morgan Stanley put out a note last week saying that global equity funds have not shifted away from the U.S. yet, and the amount of U.S. dollar bonds held by foreign investors is the highest ever. And ultimately, they said that this shows there are very few alternatives to the U.S. right now, so in the near future. So I think it's safe to say that investors are now thinking about what they should do with their U.S. dollar assets.
Right. Whether the fear is overdone or not, having a doubt in dollar assets is already a big shift from before. In investing in U.S. dollar and dollar assets used to be a pretty much no-brainer for investors.
Yeah.
They were considered as safe and granted some generous amount of yields. But the Trump turbulence became a wake-up call for some investors to cut down some of their U.S. dependence. Where did they shift to, Jada?
So Lisa briefly mentioned the Hang Seng Index and Kospi, but investors explored other deep markets, namely European and East Asian assets. And when looking at the first half of 2025, Hong Kong and South Korea stock markets were basically the winners, I would say. Both of their benchmark indexes rose between 20 to 30% in the first half as investors sought out alternative destinations from the U.S. They each had their own positive momentum as well. South Korea just came out of a snap presidential election that fueled hopes for market reforms, while in Hong Kong, the IPO market is roaring back to life, and it's giving investors an opportunity to really chase returns. The dollar weakness also led to East Asian currencies like the Taiwanese dollar, Japanese yen, and South Korean won make strong gains in the first half of this year. Institutional investors, mainly insurance companies, gave an additional boost to such East Asian currencies by selling the dollar for the local currency in a bid to increase their hedge ratios and soften the blow from the greenback's weakness. For Japan, the Nikkei 225 last week touched a 11-month high. It's around, I think, 2,600 points away from its record high of over 42,200 and 20 points, which it reached in July 2024. And when looking at specific factors, I think one we can't really miss is the corporate governance transformations and the stock market reforms. Slide 7, please. So investors are starting to take notice of companies becoming more conscious of their capital efficiency, thanks largely to the Tokyo Stock Exchange's push. So back in 2023, the TSE requested companies to be more conscious of their capital costs and stock prices. And they also asked for companies to disclose concrete action plans. Coupled with pressure from activist investors, Japanese companies are really starting to accelerate their transformation. Japan Inc. has conducted record buybacks while also doing more carve-out deals. It's unwinding more mutual shareholdings, which has been a long-running sort of issue in Japan. And these all have helped investors, especially foreign ones, to consider Japan as an attractive asset allocation destination. And according to the TSE, foreign investors have been net buyers of Japanese stocks for 13 consecutive weeks.
Right. So some known investors have opened up new Tokyo office or ramped up their presence in Tokyo in the past few years as they saw opportunities in Japanese market reforms. So coincidentally, the reforms have provided the foundation for some of these shifting money to come to Japan. Could you put up a slide 8, please? Jada did a Trading Asia related to the 10-year anniversary since the implementation of Japan's corporate governance code last month. So I would again appreciate if you could take a look. Additionally, Lisa, I hear some investors are willing to take some more risks and they're diversifying their money into Asian bonds.
Yeah, absolutely. So could you help put out slide number 9, please? So the sell-off in U.S. Treasuries that I mentioned earlier didn't really impact Asian debt. Asian bonds look to be more resilient than those in the U.S. And T. Rowe Price said that Trump's tariffs will create, quote, significant headwinds, quote, for Asia's economic growth, and that will ultimately allow Asian central banks or have Asian central banks respond by accelerating rate cuts, which will then in turn be supportive of Asian bonds. OCBC put out a note recently saying that Asian local currency government bonds have shown some degree of decoupling from U.S. Treasuries, and the company forecasts that the government bonds of China, South Korea, Malaysia, and Singapore could potentially benefit from increased inflows.
Very interesting observations. Looks like the investors are doing a lot of things to mitigate and minimize the impact from the policies of Mr. President. And some are even trying to benefit from it. Now, we should move on to our third big question. What market impacts should we expect as the pause expires? As we mentioned at the very beginning of the seminar, the situation has shifted overnight, and yet there are still full of uncertainties, and there's still a lot of questions to be asked and answered. Let me start with this, Lisa. Was this whole pause a breathing space or delayed consequences for investors?
I think it was a bit of both because stocks have, until today, or I should say until yesterday, stocks have rebounded, currencies were relatively stable, and volatility came down. But of course, it's delayed consequences because Trump is and has been very unpredictable. And when I talked to economists yesterday while preparing for this webinar, some of them even floated the possibility of a third deadline. So they were saying that August 1st might not be the deadline. So we have a lot of uncertainty and unpredictability up in the air. And also, U.S. courts of appeals will hear arguments on July 31st over whether Trump's decision to use emergency powers to impose these reciprocal tariffs on Liberation Day was legal or not. So delayed consequences looks to be the case for now.
Right. So Trump administration is saying that most tariffs would take effect on August 1st, and the period between July 9th, which was originally set as the pause expiration date, and then newly set August 1st will virtually be an additional time for negotiations. Might there be further extensions or not? How would investment and trade flows to be affected in each scenario, Lisa?
So Jada kind of mentioned this. There's a taco trade. Trump always chickens out, and HSBC put out a note earlier this week that some investors believe that this new delayed deadline of August 1st that we got is another example of taco, meaning that more deals will be in the pipeline. So we have that overhang. And then Bank of America said in their mid-year outlook that ongoing economic uncertainty and Fed cuts will keep the dollar from rebounding, and that investors, global real money investors, are just starting to, or if not, they've just started to look into whether or not they want to increase their hedge ratios of U.S. assets. And on top of that, the U.S. administration continues to push for a weaker dollar. So they said that all of the three factors that I just mentioned point to a weaker dollar.
I see. So Jada, what has escalated along with the trade tension is the Middle East crisis. And although the ceasefire agreement was reached, President Trump over the weekend said Iran has not agreed to inspections of nuclear facilities or to give up enriching uranium. What are the market views over the Middle East situation?
So I think uncertainty is, again, a big theme here. But the ceasefire between Israel and Iran came abruptly after 12 days of conflict. But the situation in Gaza and the standoff between the two countries is far from resolved, according to a lot of economists and analysts I've talked to. Hamas has said that it has responded in a positive spirit to a U.S. brokered Gaza ceasefire proposal, but details on the truce remain unclear, and both sides are still grappling with the damages. So there are some skepticism over whether the implementation of the deal will go smoothly. On Monday, Trump met with Prime Minister Netanyahu of Israel, actually, and both sides are discussing how to push forward with a 60-day ceasefire proposal to pause the conflict in Gaza. Trump also said that the U.S. will hold a meeting with Iran soon to try and get a nuclear deal. Meanwhile, it was reported that Iran's foreign minister warned recently that if Israel is not held accountable for its attack on Iran, the whole region and beyond will suffer. So many analysts, economists consider relations to be still very fragile. If tensions flare up again, it could easily affect oil prices and damage market sentiment. I mentioned the Strait of Hormuz earlier, but if Iran does indeed take that step to close it, the global economy will impact it massively, as it is a waterway where around 20% of the world's gas and oil moves. In one report, Goldman Sachs said that Brent oil could go up to $110 per barrel if the strait is actually blocked. So geopolitical tensions in the region will likely continue to challenge market sentiment. On the other hand, OPEC Plus has actually increased its output in recent months and also agreed over the weekend to up their collective production of crude in August. So this will make it easier for oil to fall into excessive supply, just as long as the tensions don't flare up again.
I see. So we are seeing all these uncertainties. Could you put up slide 10, please? This is a screenshot of an interview story with the Bank of Thailand governor. Our staff writer in Bangkok interviewed him, and we ran it as a Trading Asia in June. And the governor warned that the world will start seeing the real economic impact of the tariffs in the second half of the year. Yet, stock markets are seeing a trend of a rebound, and as we see a reboot of tech stock rally, we would have to watch how the market troubles after this overnight announcement. But Jada, markets underestimating the real economic impact of the tariffs.
So Lisa did mention earlier about a AI kind of fueled tech stock rally, but tech stocks experienced a dip earlier this year, but are again gaining steam amid confidence in the AI sector. Slide 11, please. The ICE Asia Tech 30 Index. This captures the performance of the 30 largest tech-related companies listed on Asia-Pacific exchanges. This is up 18% so far this year, and it's outperformed the Nasdaq as well as Japan's Nikkei 225 and other broad benchmarks in the region. We are seeing AI-related stocks rise, mainly chip makers, but also companies like thermal cooling equipment makers, data centers, and other related companies as well in markets like Tokyo, Hong Kong, Taiwan, as well as South Korea. Strong earnings have boosted investor appetite for such growth stocks, while bullish comments from NVIDIA have also helped fuel optimism about the sector. So the main question is, I think, will this rally continue? And I think it really does depend on how U.S.-China relations will move forward and what will happen to the U.S. economy. So far, U.S. and China have agreed to a trade deal and are working the last bits of it, it seems. So fears over a tariff war, which we saw in April, where levies were over 140% ridiculously high, have receded. Concerns over the U.S. economy have also become somewhat milder, I think, when compared to when Trump first introduced his due to Trump introducing his 90-day tariff pause. And not many are expecting a full-blown U.S. recession. Now, this might change following Trump's new tariff letters. But so in other words, I think these two factors will be the main risks that could possibly put a stop to the tech rally. So one is a setback in U.S.-China trade deal, and the second would be a recession in the U.S. which would dampen demand.
Interesting. So Lisa, we've talked about how industries and investors are bracing for the tariffs impact. One of the ways was to diversify away from dollar assets. The real economy might be shifting its supply chains. Are these tariffs signaling a permanent shift in global trade and global investment patterns?
It's hard to deny that U.S. exceptionalism is now under a lot of scrutiny. People are asking whether they should increase their hedge ratios or whether they should where to diversify into. So there's a lot of questions being asked around U.S. exceptionalism. And shifting away from U.S. assets won't happen overnight. It likely won't happen over a few months, but it would likely, if it were to happen, it would happen over a very long period. And that's not really much of a surprise because U.S. exceptionalism has been around since the 2008 financial crisis, or after that crisis, I should say. And it's helped attract a lot of capital into the U.S. and funds overweight positions to the U.S. So some analysts say that it's more of a process, rebalancing their portfolios rather than a rotation out of the U.S. But I think all of this points to questions around U.S. exceptionalism, and sort of the genie is kind of out of the bottle now. And I think inevitably, if one of your most biggest and most relied upon trading partners asks that you pay larger than expected tariffs, with giving you little certainty over whether this would be a one-off or whether there would be more tariffs in store. I think it's you're bound to look for what options you have.
Right. So I guess don't put all eggs in one basket, I guess.
Exactly.
Okay. So within Asia, specifically, Jada, what kind of change or shift do people in Asia expect from the trade war stirred by the President Trump?
So at Nikkei Asia, us reporters, Lisa and I, and all other reporters get the chance to interview leaders, not just in finance, but in other areas like business and politics. So there have been opportunities to hear directly from them about what they have to say about Trump's tariffs and global trade overall. Slide 12, please. So as we saw during the Future of Asia conference back in May, this is an annual event hosted by us. For many Asia countries, Washington's launch of the reciprocal tariffs have led to talks about increasing intra-ASEAN trade and deepening ties with partners like China. Former Malaysian Prime Minister Mahathir Mohamad urged Southeast Asia to deepen trade with China and India, while Cambodia's Prime Minister Hun Manet said his country's businesses and communities must pursue industrial recalibrations. Bangladesh's interim leader Muhammad Yunus also expressed ambitions for his country to play a bridging role between regional groupings. I also had the opportunity to interview the head of ASEAN's business lobby, and he believes the bloc and Japan can work together in areas like AI, while there are also rooms for countries in the region to collaborate on areas like hydroelectric dams and undersea cables. In a recent interview, Yura-san, you mentioned this earlier, but the Bank of Thailand governor said that there are opportunities for greater integration in the region, especially within ASEAN, plus its partners. As Trump keeps countries guessing really what his next moves will be, it's likely that ASEAN and other Asian countries will increasingly look towards each other for trade and collaboration. However, I think it is hard to say whether this will lead to the complete isolation of the U.S. While trade relations will likely deepen within Asia and between other parts of the world, such as Europe, the U.S. will still be very much in the picture, I would say, as no country will be willing to really cut itself off from the superpower.
Excellent. So thank you so much, Lisa and Jada, for great insights from your intense market coverage. Surely we live in a very unpredictable world, but for now, I'd say the key takeaways from this panel discussion are: one, don't let your guard down, as we will still have to sail on Trump's rough waters. Two, though investors were shocked at first, they quickly regrouped and found ways to mitigate the impact or even benefit from it. Although some assets looked recovered from the initial shock, it might have caused tectonic shift to the global trade and investment. And lastly, four, after the announcement overnight, the August 1st will be the new date investors would keep in their mind for the near future. So, okay, that wraps up our panel discussion. We will now proceed to a Q&A session. We have received hundreds of questions submitted ahead of the webinar. We would like to thank you so much for sending them in. We've been receiving questions also during the webinar, and we would like to answer them as many as possible. Let us start with this question, which was submitted from the audience ahead of the webinar. So the question is, how will the reciprocal tariffs impact the BOJ rate hike cycle, the yen, and the bond market? Do you want to take this question, Jada?
Yes, thank you for the question. I think there's a strong interest in what the Bank of Japan will do, not only because it's the central bank for the world's fourth largest economy, but also because it's sort of on a different path from its peers. Market watchers are, betting on U.S. Federal Reserve to cut rates sometime soon, while the ECB, Australia, the Philippines, South Korea and India, I think, have so far already cut rates this year. The BOJ, on the other hand, is on a path to raise rates after decades-long deflation in Japan. It made that shift in March 2024 and so far has raised rates a total of 3 times, last time being in January. So this is before the Trump tariffs. However, Trump's tariffs have turned into serious roadblocks for the BOJ. Governor Kazuo Ueda has stressed that there is still very high uncertainty surrounding trade policies and its impact to economies, as well as inflation, which is a key indicator that they look at. Median estimates among brokers, according to data by FactSet that I checked most recently, showed that one more hike is still expected by the end of this year, possibly in October, and another hike sometime in 2026. This month, BOJ member Hajime Takata also expressed that the bank is merely pausing its rate hikes due to tariff uncertainty, and that the bank should resume its hikes after that said pause. But the new 25% tariff rate that Trump just introduced for Japan, as well as the levies on automakers still there, concerns may rise going forward. And clearly, Tokyo is having a difficult time negotiating with Washington. In terms of the market outlook for the yen and bonds, more brokerages are forecasting the yen to appreciate against the dollar as the BOJ moves. It's still on a monetary normalization path while the U.S. is looking towards rate cuts. Nomura Securities, I believe, is assuming 135 yen per dollar for their 2025 year-end outlook, and a lot of other brokers are also putting it around 140 yen per dollar. For bonds, yields are expected to remain at high levels, especially for ultra-long bonds, there are two main reasons for this. One is that Japan is experiencing a oversupply but lack of demand problem. Authorities are trying to fix this issue. The finance ministry is reducing the issuance of ultra-long bonds, and the BOJ has decided to decrease its government bond purchases at a slower pace starting next spring. But market watchers are skeptical about this leading to an immediate fix in liquidity for the ultra-long bond market. And reason two is that fiscal concerns are also rising as the July 20th upper house election approaches, and discussions over a possible consumption tax cut is accelerating.
See. So it surely is very difficult to come back to the world with rates after decades without them. So we want to move on to the next question, which is another one from the audience, the pre-submitted question. So Japan's auto sector is a cornerstone of the export-dependent economy. Automakers are bracing for major dent in their earnings this year due to Trump's 25% additional tariffs on autos and auto parts. Tell us more. Could you tackle this question, Lisa?
Yeah, so actually Jada and I wrote a story, Trading Asia story about it. Trump has long complained that American cars don't really sell well in Japan, whereas Japanese cars are hugely popular in his country. And while there was brief optimism here in Japan when we saw the US-UK deal reduce auto tariffs for British cars, but analysts and portfolio managers who Jada and I talked to for that story said that Japanese cars are sort of in a different bracket compared to British cars because British car makers largely sell luxury vehicles in the States, whereas Japanese cars target more of the masses. And a Citi analyst told us that a deterioration in estimated earnings per share led by autos will or could eventually pull down Japanese stocks. And it's a very concerning situation for Japanese automakers. And we saw Mazda president issue a very frank assessment about what to expect ahead back in May. He said that he's telling his business partners that he is going into quote unquote survival mode. And the outlook looks to be grim for other automakers too. Honda said it expects 70% drop in net profit. Toyota, which is the world's largest automaker, said that it expects a 35% drop in net profit. So the situation is very concerning. But nonetheless, Japanese automakers are really trying to get on Trump's good side. Subaru said that it's investing 40 billion yen to expand production in the States. Mitsubishi is considering using a U.S. factory that belongs to one of its partners, Nissan. And Honda said back in March that it plans to produce some of its cars in Indiana instead of Mexico. So,
I see.
Yes.
So trying to sail through rough water with creativity, basically.
Yes.
Yeah. Okay. So the next question we would like to ask Jada to answer, which will be, can another currency replace the US dollar?
So Lisa and I have actually had a lot of opportunities to talk about this, especially after the Liberation Day tariffs, and the shift away from U.S. dollar assets accelerated, as well as the somewhat of the erosion of the U.S. Exceptionalism concept. But to cut to the chase, I think the consensus seems to be no, there are no other assets, at least at the moment, that could replace the U.S. dollar. And if it were to happen, it won't. It won't for a very, very long time. So in the past, we saw the shift from the sterling to the dollar due to the World War II, and but without such a big event, there won't be really a de-dollarization in the sense of that such a complete overhaul. the share of the U.S. dollar could fall in the coming decades. Right now, it actually accounts for about a little under 60% of global foreign exchange reserves. But in the 70s, it was like over 80% or so. So we are already seeing the U.S. Dollar share drop. So in the years to come, the dollar share could keep falling, albeit very slowly, and with the euro and yen rising instead. There is also the view that the Chinese renminbi or yuan could become more powerful, especially if it becomes convertible. That's, I think, the key part. And China sees the yuan as a rival to the dollar. And at a forum last month, I believe, the governor of the People's Bank of China actually said that the global monetary system could evolve in a way where a few sovereign currencies coexist, and so they can compete and check and balance each other. So there are also some who point out that in the near future, the yuan could replace the Japanese yen as sort of a key currency within Asia.
It's going to be a big shift. So the fourth question I would like to ask Lisa to answer, and this is from the audience again. It's a pre-submitted question. What do continued heightened trade uncertainties mean for Asia's sovereign credit conditions?
So last week, Moody's rating put out a statement saying that it's changed its outlook for sovereign creditworthiness of the Asia-Pacific region to negative from stable. Moody's said that the uncertainty around trade and potential overall or the shift that we're seeing in global trade has raised cyclical and even potentially structural credit risks across the Asia-Pacific region. And one thing to note is the U.S. is pushing countries or partners to spend more money on defense spending. And last month, NATO leaders agreed to spend 5% of their GDPs on defense spending and the Pentagon by 2035, that is. And since then, Pentagon has urged Asian countries to follow suit. And actually, Moody's rating mentioned that. Mentioned the increased calls or the increased need for Asian countries to increase their defense spending. And what they said was if Asian countries were to spend more money on defense spending, it would further make Asia's post-pandemic efforts for fiscal consolidation more difficult.
I see. That's a very good point. So we would like to go to the fifth question, and this is for Jada. How have tariffs affected alternative asset classes, namely cryptocurrencies and gold?
Okay, so Bitcoin is trading above 10,000 US dollars, and I think it isn't so far away from its all-time record. The crypto had sort of a lackluster start in 2025, at the beginning of 2025, and also experienced a dip after the Liberation Day tariffs in April. But since then, it's gained strong upward momentum, I would say, as more institutions are loading up on and driving up the price, really. Last month, Metaplanet, which is a Japanese hotel group, it said that it would raise about over $5 billion to add to its large stockpile of the crypto. And on Monday, actually, it did acquire another over 2,000 Bitcoin for, I think, around $230 million and is really ramping up its purchases. Money is also flowing into U.S. Bitcoin exchange traded funds, ETFs, such as the ones run by BlackRock's. Escalating tensions could propel investors to seek out alternative assets like Bitcoin, and there are also views that rising tariff risks and the erosion of that U.S. exceptionalism concept could lead to Bitcoin becoming a hedge against such risks. Turning to gold, the precious metal is up around I think a little under 30% so far this year, and it touched a record high of above 3,500 per troy ounce in April, again after the Liberation Day tariff, due to so-called safe haven flows. And central banks, mainly those in emerging markets, and including China, have also purchased large amounts of gold. Some analysts expect the gold market to remain sort of top heavy because the central banks have already bought enough gold, front loaded sort of, but there are also more bullish outlooks. J.P. Morgan, for example, predicts that prices of gold will reach $4,000 by the second quarter of 2026 due to the ongoing trade chaos and recession probabilities in the U.S. So again, safe haven flows will increase. I've actually also heard that some investors, including family offices and insurers in markets like Singapore and Japan, are starting to consider deploying capital into Australia's private real estate credit market in search for stable, consistent income-generating returns, and especially amid the shift away from U.S. assets.
An interesting move. Okay, so we're now nearly 1 hour into the webinar. Let us answer one or two more questions before wrapping up. We'd like to take the next question from our live audience. I would like this one. I'd like Lisa to answer this one. So Trump's trade war is prompting money managers to adjust their equity exposure to China. How are they repositioning? That's a good question.
Yeah, so actually, I think we wrote a story on this a bit earlier, and I think there are two different camps. The first camp is folks like T. Rowe Price, who are overweight Chinese equities, and they're still waiting for the Chinese government to roll out more support, and they're hoping that would give mainland or Chinese equities a bit more support. Whereas we have folks like Amundi that has a defensive positioning in Chinese equities, and they prefer staying in domestic demand-oriented sectors and high dividend sectors. So we have these two camps, and I think it really depends on government stimulus and also whether demand will come back in mainland China.
Okay, so the next one will be our last question of the day. And this is from the live audience again. So Jada, what sort of moves are noticeable in stock markets for countries like India and Thailand?
Yes. So while I think our correspondents in Bangkok and New Delhi are probably more of an expert on this, but there have been significant movements in those two markets, I would say, very noticeable. Thailand, for example, has seen stocks tank really, with the benchmark set index is around a 5-year low. The country experienced a big earthquake in March that affected some flows into the market, and now political turmoil has shaken the market as well. There are concerns over that the conflict with Cambodia could hurt Thailand's economy, which is very tourism dependent, and that the country is yet to make a deal with Trump. And I believe Trump has threatened a 36% levy on Thai exports. Over in India, meanwhile, stocks have recovered from the April dip and is closing in on its record high, which it touched in September of last year. This is likely in part due to India's stock benchmark being comprised mainly of non-cyclical listings, so more stocks, companies of financial services companies, pharmaceuticals, and also IT internet service players. New Delhi is also working on a trade deal with Washington. India's name was not on the list of letters Trump just sent out. And while details of an interim trade deal with the two countries is still unclear, it's been reported that U.S. has indicated that it may allow negotiations to continue until the extended August 1st deadline. And I do want to mention that also for Singapore, who faces a rather lower levy of just the 10% universal rate, their stocks have soared. The benchmark STI index is at around record high levels.
Oh, so different reaction within the region.
Yes.
It's very interesting. Okay, so thank you so much both. That'll be the end of our Q&A session. Thank you so much for tuning in. Our webinar is nearly coming to an end, but not just yet. We'll share access details of the webinar archive by July 14th. We will continue this Nikkei Asia webinar series. So please take a few moments to complete our survey from a QR code, which will appear after the webinar. Your voices are very important to us for improving the quality of our webinars. Thank you, panelists. Thank you, audience, for your participation. We will now close the webinar.